Hello viewers, welcome back to our YouTube channel CPA Charles Cafe Accounting Tutorials, and today we want to kickstart our discussion on bank reconciliation. We want to look at how can we be able to prepare the bank reconciliation statement, and today we are going to mainly focus on the theoretical aspects of our bank reconciliation statement. So we are going to look at the bank reconciliation, and this is going to be part 1 of our tutorials. So we are going to look at a series of different aspects that are going to be forming up our bank reconciliation statement, and that's what we are going to basically look at for now. So without wasting more time, allow me to take off my video so that we can dive into what we are going to cover for today. So welcome once again to our session of our accounting tutorials, and today we want to look at bank statement reconciliation. In other words, bank reconciliation statements, and you want to understand what bank reconciliation is all about. Now, bank reconciliation is all about the fact that a firm or any organization or business entity operates a current account. It comes into play because an organization operates a current account with their bankers, wherever they put their money, the company's money, whichever bank. Most of the times they operate current accounts with their bankers, and it is expected that at the end of every period, most especially at the end of every month, the bank column of the cash book should be agreeing with the bank statement in terms of the balances that are there. So we expect that the bank column, remember when we looked at the cash book, we said the cash book has a bank column and then a cash column. So we expect that the bank column of our cash book as a business is expected to be the same in terms of their balances with the bank statement balance, because at the end of every month we can pick our current account statement or ledger. We look at how it looks like, but we expect that the balance at that bank statement should be the same as the balance in our cash book, especially the bank column of our cash book. So that's what we expect. So we want to see that the balance, we want to see that we actually have the same balance that we have in the cash book as the same balance that is there in our bank account. And that's basically what a bank reconciliation is all about. A bank reconciliation is just looking at a situation where you can be able to make the cash book balance look exactly the same as the bank account balance at a given period of time. So that's basically what bank reconciliation is all about. However, it's not always the case. In other words, you are not going to find it in a sense that the balances with our cash book is the same as the balance as per the bank statement. Most of the times, the balances are not going to be agreeing. And it may happen that we, as the company, we think that we have, let's say, you can assume that maybe we have $20,000 US dollars in your bank account. And that's according to what you have paid, what you received, and you are certain that I must be having $20,000 on my bank account as the balance. Or if you look at your balance, your cash book in the bank column, it says that the cash that you are supposed to have in the bank is supposed to be 20,000 US dollars. Now, most of the times it's not going to be the same. Because for you may be expecting to have 20,000 US dollars in your bank account, but surprisingly, when you go for the bank statement for that particular period, you will find that that balance is either higher or lower. Because you can say, for me, I expect to have maybe this, but when you pick your bank statement, you find that maybe the balance is 12,000 US dollars, or it is maybe 25,000 US dollars. But for you, as per the cash book in the bank column of your cash book, we are seeing the balance should have been 20,000 US dollars. So you can have a higher figure or a lower figure. And that's most of the time what happens. So you find that your cash book balance in the in the bank column of the cash book is not the same as what you were seeing on your bank statement for a given period of time. Now, all that mismatch is the one that calls for bank reconciliation. We are trying to make sure that these balances agree. In other words, bank reconciliation comes into existence when we have such scenarios that for us we expecting to have maybe $20,000, but when we pick our bank statement, maybe we are finding we have 25 or 12,000, depending on whichever amount that you have seen for a given period of time. So that mismatch is the one that is calling for the bank reconciliation, because bank reconciliation looks at reconciling the balances of the cash book as per the bank column of the cash book with the balance that comes out in the bank statement for a given period of time. So what we are going to look at here, we want to see what causes this mismatch. When in our books, it shows that maybe we have 20,000 in the bank column of the cash book, but then the bank statement amount is not actually tallying with what we have. So what causes that? And once we have realized that we have a difference or we have a different balance, then we shall need to prepare the bank reconciliation statement. So the bank reconciliation is the process, but what we prepare, we always prepare the bank reconciliation statement. We always prepare the bank reconciliation statement. So we prepare that bank reconciliation statement so that we can reconcile the cash book balance with that of the bank statement balances. And that's what this topic of bank reconciliation is all about. But now you have to remember that when you want to open an account with any given bank as a business, if you are coming as a business, there are very many different types of accounts that we can open. You can go to the bank and you say you want to opening an account for your business, an account for the business. And we said there are very many different types of accounts that you can open for your business. And among the different types, the types of accounts, someone can open, we can have a savings account for our business. We can have a current account. And finally, we can have a fixed deposit. So you need to remember that there are mainly 3 accounts that we can open for our business. Now, if you try to look at these fixed deposit accounts, if I may start with it, the fixed deposit account, usually we don't operate it with our business. Like, it's not always operated except when you want to do an investment, because a fixed deposit is where you put money in the bank to accumulate to a given amount. When you put it could be a fixed amount that you are saving maybe every month to accumulate to a future sum, or it could be a varying amount. Anytime you come, you put money, but that money cannot be withdrawn before the other period you had agreed elapses. So that's why we are saying most of the times we don't operate this fixed deposit account unless you want to do an investment. Because for this account, you keep a certain amount with the bank and it is expected to mature at a fixed period of time, meaning it's supposed to mature in future. You can say I'm saving for 2 years, but after 2 years, I can withdraw the money. So you can save a fixed amount. Let's say I'm saving 1 million every month for 2 years. Or you can save any amount. They can set for a threshold that may be, as long as you don't bring something that is below 500,000. You can bring 700, 1 million. The other time you bring 1.5. This time around you have managed, maybe you did get the money, you have just put the 500, which is the threshold. So the amount can keep on varying. But the motive is for you to withdraw that money after some period of time. So it is always good for investment, because in that fixed deposit account, you earn interest for the money that you have saved for a given period of time. So it is always good for investment, but as long as you want to just use it for business operations, it's not always opened for the business. Because the moment you keep putting that money, it's going to be fixed, and you can only be able to access that money unless when that fixed period has expired or is done. Also, this savings, the savings account is an account where you make savings, and usually it doesn't operate with a checkbook. In other words, you put your money, then you can go and withdraw anytime you want. So it operates with savings. It doesn't operate with checkbooks. In other words, you can't sign a check. You can't have a checkbook for a savings account. 2, you can't, when you have to withdraw money, use the withdraw forms. There are those forms that you can sign and you withdraw money. If allowed, maybe you want to withdraw more than what you can withdraw using your ATM card or debit card or credit card, whichever. So, but now for this current account, this is where I want to put my emphasis. The current account is the one that is applicable to business, because it gives someone access to a checkbook, whereby you can have a checkbook. Others write it as a check like this, but for this checkbook, you'll have access to a checkbook. And because someone is going to ask himself or herself that why do I need a checkbook? A checkbook will allow you to save time. In other words, if you want to pay a supplier, there is no need for you to be moving at the bank. You line up in those different lines because you want to access money. What you do, you just sign a check, then the other person will go and cash it out from the bank when you're not there. So the checkbook gives you that allowance, that not every time that you need a small amount you have to go into the bank and withdraw the money. You can just sign a checkbook for someone to go and withdraw. So most businesses operate this current account because the current accounts avails you with the ability to sign a check, and then you can give to the person to go and withdraw money from your account. And that makes the business transactions simple, because just imagine if you are supposed to be lining up for every transaction that you want to make, that today I want to pay this, today I want to pay this. So you find yourself every day you can pay like 10 people, and all those 10 people you have to go back and line up and withdraw cash, then you come and give them. So if you operate a current account, it's going to allow you have smoothen the process, because you can just sign up the check. You don't need to go and line up, and every time you want to withdraw some money for business from your business bank account, business current account. And that's why that's basically the main reason as to why businesses are operated on current account. Now, current account, if we are to focus on these current accounts make you own a checkbook, as I said, which makes business a very flexible, and you can have because it gives you that flexibility, that not every time you need some money you have to go line up and be able to access some money, even for a small amount. So most of the times we operate current accounts. So that's what we are going to basically focus on for the whole of this lecture. So whatever we are going to be talking about as far as bank reconciliation is concerned, just know the account that we are mainly focusing on is a current account, because we said that these current accounts, they are mainly operated for those businesses that operate current accounts, and they are the ones that prepares a bank reconciliation statement. Because the main reason as to why it is in that sense is that someone can go and bank money without you knowing. Two, I can say I've paid someone, but the person doesn't go to take the check to the bank to be cashed out. Otherwise, if we were to pick money ourselves, we pay our suppliers, we pick money, we pay everything, we wouldn't be having all these kind of mismatches, because we would be seeing what is happening on our account every time we go to maybe to make withdrawals. But since we just don't go there all the time, we find that the balances are going to be differing, and that's why you need to prepare a bank reconciliation statement to adjust those balances to make sure that they are the same, and it is very important. But before that, I want us to, before we look at the bank reconciliation statement, I want us to look at how the bank statement looks like as compared to the cash book, or as compared to how the cash book looks like. We can maybe just have just a small illustration of how a bank statement looks like. Maybe for those who may not actually know, but even if you don't know, this is how the question is going to be. Most of the time it's going to be appearing in this kind of format. So let's look at the bank reconciliation. Just something small, talk about the bank reconciliation, the bank statement. The bank statement. But I want you also to remember that for the cash book, we have the 2-column cash book, we have the 3-column cash book, because I told the other single column cash book, it doesn't, most of the times it doesn't appear. But we always operate a 2-column cash book or a 3-column cash book, and the other petty cash for some organizations. And we said for the 2-column cash book is that type of cash book that has got 2 columns for both cash and the bank columns. And now the cash book that we are going to be talking about here is the bank column of the cash book. In other words, we don't need the cash column. What we are focusing on, we are looking at only those transactions that went through the bank, only business bank transactions alone. They are the ones that we are looking at. So we extract that single column for the bank that shows the bank transactions. It's the one that we want. We want only the column that has the bank transactions alone. And what we do is that whatever we record in the bank column of the cash book is expected to be recorded in the bank statement. And that's what always happens in the bank statement. So the transactions that we have in that bank column of the cash book, they are going to be the same transactions, but the only difference is that for the bank statement, the way we record items in the bank statement, or the way items are recorded, it's a little bit different from the bank column of our cash book. It's a bit different because in the bank they will have, for example, now when we are receiving cash, or when you have cash into our bank account, when we are receiving cash, or when we are putting cash into our bank account, or when we deposit cash into our bank account. Because most of the times when we think that our bank account is increasing, then we, the business, we will record it on the debit side of the cash book. But at the same time, the bank is expected to credit our bank account or our bank statement. So we are debiting the bank when, for us, we are debiting the bank, the bank account. in our cash book. The other guys are going to be crediting our account, because in the banker's books we are going to look like we are a liability. For example, the other bank is going to be keeping our money. It's like we have lent to the bank. That's why when you are working in the bank, you are the accountant of the bank. The money, people's money, are going to be liabilities that you have, because every time they increase their money in your bank account, you are going to be liable for their money. That's why every time for us we debit our cash book, but the bank is going to be crediting, because it's going to be a liability to them. But for us, we are debiting our account, and the other side they are going to be crediting our account. So just like the more you keep the money in the bank, the more you increase the liabilities for the bank, because the bank will be holding people's money. That's when you go and withdraw money from your bank account, for you are going to credit your cash book in the bank column, but the bank is going to be debiting your account. The reason as why they are going to be debiting is because you are reducing the liability. You had kept your money there, so the liability was high. The moment you keep on reducing, they debit your account, because you are now reducing the liability that you had with them. So it is a little bit different the way we do the transactions in the cash book when we debit, because for him, as per our cash book, we always think that the cash book is having a debit balance, so it has some money for us in the cash book. But when you look at the bank, your bank account, the more you have, the more credits you have, it means the more money that you have on your account. That is the implication. Because in the cash book, it's going to be a debit balance, but with that debit balance in the cash book, of course, it is a plus for the business. And the credit balance in the bank statement should be equivalent to the debit balance of the cash book. But what we've said, that when the bank is debiting your account, then it means that they are rather reducing your account, and that means that the equivalent of your debit in the bank account is the credit in the cash book of the business. When we withdraw money or when we pay people, we credit our cash book. And crediting our cash book, if we have paid them by bank, automatically our bank account is going to be reducing the amount. So the implication is that the more you credit your cash book, we expect the same proportion should be reduced from your account. The more you credit your cash book, then the alternative should be the more the bank should debit your account. That is the implication. And the more you receive money, the more you receive money, meaning the more you debit your cash book in the business, then it means the same proportion should be at the bank when they are crediting your account, to show that reflection of the money that is in that account. I hope you are getting this, because we expect that the balances of the debit balances should also be the same as the credit balances. Like what you have recorded as the money you have received in the business should be the same money that is there in the bank statement. But your bank statement is going to be recording it in the credit column. But for you as a business, in your cash book, you are going to be recording it as a debit entry. So that's what we are basically talking about. So let's look at the format. Now, for the format, of course, we always start with the dates. Then we have particulars or details. Then we have the debit side. Of course, this one has a current sign, but I will put in later. Then you have also the credit, the debits and the credits. Then we have also a column for balance, and this is how the bank statement will always look like. So we can have things like maybe Jan 1st. We can have maybe the balance for the previous period. This will be the balance brought down. It's not going to be in any of these. It's going to be this side of the balances. Let's say we have 1,000 US dollars. Let's say all these are in US dollars, the currency. So once you start the transaction, maybe on 10th, we've gotten some customers deposited some money. Let's say maybe Stuart. When the customer deposits the money, your cash book is going to record a debit balance. But for us in our bank statement, it will come as a credit. So if Stuart paid us $2,000, meaning the balance is going to keep on adjusting itself. We are going to add this plus this. It is going to give us 3,000. If we withdraw, now, if let's say we look at maybe on 15th and we withdraw, there is a cash withdraw. Cash withdraw, it's going to be on the debit side. Let's say we have withdrawn maybe 500. If we withdraw 500, the balance has to reduce. You will get the 3,000 minus the 500. It will give you 2,500. Now, the expectation is that this balance, sorry, this is 2,500. So the expectation is that this balance here, the 2,500 that is there as your balance as per 15th, should be the same balance in the cash book as per that same date of 15th. In other words, if your bank statement looks like this, the cash book will be looking like this. Let's have also we are just going to draw only a single column for we are only picking out the column for bank. So this is our cash book. But remember, the cash book, we are only taking out that bank column. So on Jan 1st, remember this one was we had some money, 1,000, which is the balance brought down. It's going to be on the debit side, balance brought down of 1,000. Then Stuart deposited 2,000. Once Stuart deposits 2,000 on 10th, it's also going to be debited because we are increasing our bank account. So this one is going to be Stuart, maybe is our customer, paid some 2,000 US dollars. Then we made a withdrawal. We made a withdrawal on Jan 15th. We made a withdrawal cash. We converted it cash withdrawal of 500. Remember here I always told you to put the currency sign, and we are working in dollars. So we close off the account. This side is bigger than, because this is 3,000, even this side must be 3,000. So as per 15th, because we are looking at 15th, that's the end of the period. This is balance carried down of 2,500. Now you are seeing that on Jan 16th, because this was 15th, Jan 16th, the balance brought down. Balance brought down is 2,500. This is what I'm meaning, that this amount is the same amount that we have in our bank here. That is the implication of what we've been talking about. But most of the times, this balance is not always the same as this balance that we have here. And if that's the case, then we do what we call the bank reconciliation statement. So that's what causes us to do a bank reconciliation. So for example, if at the beginning of the period we had maybe 2,000, let's say 20,000 US dollars in the bank as our balance in the cash book, then we should also have that same 20,000 US dollars as the amount that we shall have in the bank column. But we shall need, we are going to understand how we can adjust this. I hope now you can see that the balance that we have as per the cash book of 2,500 US dollars is the same as the balance as per the banker statement. And this is basically what we are trying to mean, that at every point in time, the balances in the cash book should be the same as the balance in the bank statement. However, we are trying to say that unfortunately, this is not always the case, because there are a lot of reasons that will cause a difference in the balances of both the cash book and the banker statement. And those factors will make you have a different balance in the bank statement, and also a different balance in the bank statement are the ones that we want to know, or they are the ones that are calling us to do what we call the bank reconciliation statement. And at the end of the day, or at the end of the period, when you get your bank statement, you find that you see that the balances that you have in your cash book and the balances that you are seeing in the bank statement, they are not tallying. And once that happens, then you'll have to prepare a bank reconciliation statement to reconcile that difference. Therefore, we want to understand the bank reconciliation statement and also learn about the factors that may cause the difference between the bank statement balance and the cash book balances of the business. And that's mainly what we are focusing on in this video. So let's try to do the bank reconciliation. We are more focusing on the reconciliation part of it. We have seen how the bank statement looks like. We have seen how the cash book, the bank column of the cash book looks like. and we've tried to be able to elaborate some of those things, but let's focus mainly on the fact that we have seen that there are some mismatches within the balances of both the cash book and the bank statement. Now, having understood that we have those differences most of the times, I want us to look at the bank reconciliation statement and we try to understand what a bank reconciliation statement is all about. So mainly, we are going to look at the bank reconciliation statement. Bank reconciliation statement. How do we come to that? So, a bank reconciliation statement is a statement, we can write something, is a statement prepared by the current account holder. Prepared by the current account holder in order to bring their balances, balance of the cash book. When you're talking about the cash book, we are meaning the bank column of the cash book. We are trying to bring the balance, of the cash book into agreement with the balance of the bank statement. And that's what we basically mean by bank reconciliation statement. It's just a statement that is helping us to match the cash book balances and the bank statement balances. However, you have to remember that I said it's prepared by the current account holder. In other words, we say that the businesses operate current accounts, and it's the current account holders that prepare the bank reconciliation statement. So you need to understand that. So it is prepared by the current account holder in order to bring balances of the cash book into agreement with the bank statement balances. And that's what we call the bank reconciliation. In other words, that's the process of reconciling the bank statement. However, as I said, that there are a lot of factors or reasons that cause the differences of the cash book and the difference of the bank statement. The bank statement balances. There are a lot of factors or reasons that cause those differences, why there is a difference between those two balances, the cash book balance and then the bank statement balances. And I want us to first try and look at some of these factors. These factors, all these causes, they are the ones that we are going to base on to do all the computations. So as long as you understand these factors, you are not going to find any problem whatsoever in doing any number to do with bank reconciliation. So let's look at the factors. Factors that cause a difference, in the balances of the cash book and the balances of the bank statement. So this is basically what we want us to understand. And as I said, there are a lot of factors that will cause a difference, and we are going to try and mention a few that will help us to understand this concept very well. And the rest of the factors, or the rest of the causes, we shall look at them as we move on, especially when you are doing the practical simulation. So we shall talk about them as and when we meet them in the bank reconciliation, in numbers requiring us to do a bank reconciliation. But I'm going to make sure that I talk about the main items that will, or the main factors that will cause a difference, because there are very many factors, as we shall see. But just know these factors, they are going to help us a lot, especially when we are solving the numbers. So you better understand them. Otherwise, if you don't understand them, there is no way you are going to apply them. Because whatever we talk about, we are going to look at it in the computation. There is no factor that we are going to look at that we shall not find in the computation numbers. So this is one of the numbers that is very straightforward. As long as you understand the concept, the rest is very easy. Now, the first one that I will mention as a factor that will cause a difference is called unpresented checks. Unpresented checks. Unpresented checks. So unpresented checks, these are checks, these are checks that have been drawn by the business, and issued to the suppliers, for payments, on whatever they are supplied, they have supplied to the business. But these suppliers have not yet presented the checks. They have not yet presented the checks to the bank, to the bank for payments. So those are the unpresented checks. You as the business, you have paid someone, maybe they have supplied cleaning services, they have brought materials, you wrote to them a check. To draw a check is just to write a check. You wrote a check to them and you handed the check to them for them to go and withdraw the money. But for them, they have taken some time, they have delayed to take the checks to the bank so that they can withdraw money from there. What is going to happen is that for us in our business, we have recorded that we have already paid those suppliers. But in actual sense, the money is still on our account because the suppliers haven't presented the checks to the bank for payment. Remember the reason as why we are operating current accounts. We don't want to go and withdraw money by ourselves and we pay suppliers. No, we just write to them checks so that they can go and claim their money. But you know, these checks matures at some point. If I give you a check today and tomorrow I pick a bank statement, when maybe the check is supposed to mature in 3 days, automatically, even if you had presented it in the bank, the money will be still on my account. So there are some small reasons, but the general picture is that these are checks that have been submitted, that have been given out by the business to the suppliers for payment, but the suppliers, they have delayed to present them to the bank for payment. So you as a business, you owe a supplier, or a supplier is demanding you some money, but later you write a check to them so that they can take it to the bank and claim the money or withdraw the money using that check. And it happens that the business picks the bank statement maybe at the end of every month. If let's say, for example, I give you a check on, let's say, today is 29th. If I give you a check today is 29th, the month is ending, is about to end. So if I give you a check today, and by maybe you take some 2 to 3 days and you have not presented the check to the bank for payment, by the time I pick the bank statement, that money will not be adjusted. But remember, in my cash book, I had already recorded that as a payment because I gave out the check. So you find that I can pick the bank statement. By the time I pick the bank statement, the supplier delays to pick the money from the account. So once I pick the bank statement, let's say for this month, this is October, supposed to end 31st. If I give you the check today, 2 days from now, the month will be ending. So if you take it on the 3rd day, you'll find that it's going to actually to show the other amount not deducted yet. In my cash book, it says I had already paid off. So that's basically what is going to happen. So my cash book will be reading a different figure, even the bank will be reading a higher amount because the other suppliers haven't picked the money that I had paid to them. So that's one of the ways that can cause those balances to be different. Now, let's now look at the other as the uncredited checks. Uncredited checks. Now, for uncredited checks, these are checks that have been received, by the business from the customers or the debtors, the people who supplied goods on credit, by the customers or the debtors, and have been paid into the bank. They have been paid into the bank, or they have deposited the checks into the bank, but the bank hasn't yet credited, has delayed to credit, has delayed to credit the money, has delayed to credit the money into our business account. So as I told you, you go and the customers, they have paid, but and they have taken them, they have presented the checks to the bank. The customers have paid by check. When they give us, they brought the check to us, we've taken the check to the bank, but the bank has delayed to credit our account. Remember, when we are putting money the other side, for us, when we receive those checks from the customers, we are going to debit our cash book that we have received the money, and we take those checks to the bank so that the bank can pay us. Most of the times it happens, some of these banks, due to different targets and what, they may delay some transactions without anything that maybe something wrong, no, but they just delay depending on how maybe they want to meet their targets. You take your check and someone sits with it, he says, I'm going to bank it, I'm going to credit, because they are looking to meet their targets. So it may happen like this is the last day. If a customer pays, today is 29th, if a customer pays me today and I take the check tomorrow, I will expect that on the 30th, the money should have been credited to my account. But by the time it clocks 31st, I pick the bank statement and I will be seeing that those guys, they delayed to credit that money. Because delaying to credit that money, it means it will not reflect on the bank statement. So for us, we have recorded it in our cash book that we have received money, and we expect that same amount to have been credited to our bank account so that we can increase the amount. Remember, these uncredited checks, if they were credited, then they would have increased our amount in the bank account, because we have already increased our cash book. In a cash book, when you receive the check, of course you debit your cash or bank. Of course it is a check. This day you are now going to debit your bank, then you credit the customer. And once you pick the check and you take it to the bank, we expect the bank to credit your account. So that is the implication. And crediting your account means they should have increased your account by that amount that was on the check. So by that, if let's say you pick the bank statement and you find this is not there, then that will also cause a difference. And as I said, the bank can receive the check and then it delays to credit the money on your account. And when the month ends, you pick the bank statement and you find that you realize that the check that you had deposited into the bank were not credited by the bank into your account at the time they received the money. So meaning that the cash book balance will always be higher than the balance on your bank statement because of those uncredited checks. And that's basically what the uncredited checks are all about. Specifically, checks that have been deposited by the business into the bank, but they have not yet been credited to the business banker account by the bank or by their financials. And I hope you can get the difference between the first one. The first one we are paying, we are paying our creditors or suppliers, but they didn't pick the money. They didn't take the checks to the bank. But here, the customers paid us, we took there, but it is the bank which delayed to credit our account. So those are two. Number three, the next factor that caused the difference is we can have standing order payment. Standing order payments or standing orders. Standing order payments. Now, a standing order is a payment, is a kind of a payment, and normally it's a written instruction. It is actually a written instruction from the business to the bank, and the business will instruct the bank to pay an expense on behalf of the business. In other words, standing order is just a written instruction. You can just call it a written instruction. A written instruction from the business to the bank to pay an expense on behalf of the business. So you instruct your bank that you'll be paying for me maybe these monthly deductions. Every month you'll be deducting some amount to a given service provider. So you instruct, you write, it's an instruction or it's a commitment that you write to commit that they should be deducting. You allow your bank to be deducting money to pay the service provider on your behalf. So you instruct your bank as maybe to pay things like electricity. You can instruct them to pay your electricity bills. So some of the standing order payment could be electricity bills, that every time Umeme sends a bill, it goes direct to the bank and the bank makes payment. So when you write a standing order, sometimes the money will be deducted without your knowledge, because the other supplier or the other third party that you are paying will just present the bill to the bank. And once the bank sees the commitment that you made or the standing order that you made, they will be paying that same amount that was identified in the standing order. They will only notify you maybe when the other person brings something more than what you had agreed on. That's when they can decline, or they can call you to first confirm. The other, they may be things like rent. Then you can have things to do with the monthly subscriptions. Let's say DSTV, you are paying DSTV subscriptions. So instead of you be lining up and paying some of these expenses as a business, because these expenses, they are relating to the business, what you can do, you just write a standing order, they be deducting the money and they submit to the other. It may be in terms of QuickBooks. With accountants, we can be using QuickBooks, and you know QuickBooks, they are going to be charging you money. QuickBooks services, you could be using payroll, you could be using anything. So that is going to be deducted on a regular interval, depending on the amount specified and the dates you have put in that standing order. And once you write any note to authorize the bank, and you ask them to be paying some expenses on your behalf, then we call that the standing order payment. So it is just a written acknowledgement to the bank, instructing the bank to pay an expense on behalf of the firm. But now, sometimes when When you do that, what is going to happen is that as the business, you may not actually know when the money has been released to the other people, because these guys, they will just be submitting the invoices to the bank for payment. So they will be sending those utility bills to the bank, and the bank will be deducting your money from your account without your knowledge. And the only time for you to get to know is when you go for a bank statement. You will find that, hey, this, of course, they paid these guys, because most of the times they may deduct depending on the dates may be varying, but the amount may be fixed, but the dates may be varying. That every time they send, they make payment. So because you don't actually know, then at the end of the period, you will see that money has been deducted from your account, and you find that the money on your balance or on your bank statement will be different from the balances that you'll be having in your cash book. Because if you had known that they have made some payment, you would have adjusted your cash book. But since you didn't know, you only find out when you have gotten the banker statement. So that causes a difference in the balance that we have in the cash book and that we have in the bank statement. So the bank statement figure, as per the standing order, will always be lower, because they will be chopping your money. For you, be having a higher value in the cash book, thinking you haven't paid some, but yet the bank has already made some payment. So when the bank makes payment on your behalf, then those are going to be reducing your bank balance. Your bank balance will always be lower, and the cash book balance will always be higher, because you haven't gotten this adjustment that they made payment of. So that's it. Now, the next point that I want us to look at is what we call the credit transfer. Credit transfer. Credit transfer is just simply means that someone putting money into your bank account without your knowledge. Sometimes it is called direct credit. Like for the customer, if let's say you supplied some customer goods on credit, and instead of these guys writing to you a check that they show that they are paying you, they just go and bank the money. They don't even send the proof of payment. So they have banked the money is there on your account. So for you to only realize when you have gotten back to pick the bank statement, that's when you will see that so and so made a payment, but in the cash book it wasn't adjusted. So meaning, if there are these credit transfers or debit direct credits, it means your bank statement figure will always be higher compared to that one of the cash book, because customers deposited money into your bank account, or you earned some interest, you earned some money. Maybe it was a bank interest that you received. You earned it and the bank didn't inform you. The customer made a payment and never sent the proof of payment. So you only realize that when you have gone to the bank to actually check out to see the money that is available. By the time you pick the bank statement, you'll find that the money that is there is higher than what you expected to be there, or is higher than what it should have been as per your cash book. And the reason why it is happening is because of these credit transfers that were made by your customers without your knowledge. So the customer, instead of them writing checks to you that they tell you that we are making payments, they just deposit the money directly to your bank accounts. And you may not be aware, especially when these customers, they don't bring the proof of payment to you. But by the time you go to pick the bank statement, you can realize that there was a direct transfer. And once you realize it, of course, you record it in your cash book so that you received some money. And that's the whole process that you will go through, as we shall see, of how we can reconcile such differences. So the direct transfer or the direct credit from your customers or your debtors, they will increase your balance as per the bank statement, causing it to differ from the cash book balances. Otherwise, if you knew, you would have maybe adjusted your cash book so that you can reflect those values. Then the other that will come in that same way or that behaves in that same way is maybe dividend paid. If, let's say, your business invested in another business, they bought some shares outside that business and they are earning dividends as shareholders, what will happen is that the shareholders may not give you notice when they are making the payment. As long as the dividend has been declared, they will pay anytime. So they will pay to your account without you knowing. By the time you pick the bank statement, that's when you realize that, of course, I received money from the other company that I made investments in. The other is also interest income, interest received. You know, the bank can charge you interest as an expense for the loan, but at the same time, they can pay you interest. Maybe you have been saving with them and you're earning interest. The interest will just be credited to your account and they will not notify you. So you find yourself, by the time you pick their bank statement, the balances are higher. So these dividend paid, interest received, they behave in the same way like the direct transfer, the direct credits. So if maybe you had invested in bonds, you had invested maybe in preference shares, you know, for shares, they give you dividends. But if you have invested in, you have given a loan to someone, they will pay you interest they will pay you interest. The cash flow will be interest. But for shares, the cash flow will always be dividend. Now, the next factor that I want to talk about is called the bank charge. Bank charges. Now, once you are operating a current account, then automatically you are bound to suffer some charges. And these charges are made by the bank for rendering their services. And sometimes it may come because of the work that they have done on a single transaction. And they may come in terms of things like excise duties. They may be like excise duties. They may be things to do with monthly management costs. I don't know, maybe, but most of the times they are monthly management fees. So any charge that may come on your account as a business, the bank may also charge you things like account opening costs, opening the account, opening account costs. And these costs may be known to you as the business only when you have gotten the bank statement, because these costs are going to be charged directly from your account. The bank will pick money from your account for those services. There are also other charges like stamp duty and others. They may be deducted based on a given threshold. So any other account that may come on your account, those charges are going to be deducted directly from your bank account, and you will not know. The only way you will know is when you have got the bank statement from the bank, maybe at the end of the month. So all these, since they are going to be deducted from your account, they are going to reduce your balance as per the bank statement. For you to be having a higher figure on your cash book, but because of this, these costs were deducted without your knowledge, or in other words, they didn't inform you, but they were deducted, then you'll find that the balance will be a little bit less than what you have in your cash book. So the next factor that we can talk about is we may have things like the wrong credits and wrong debits. This is also something that is very common. Wrong credits and wrong debits. So wrong credits and wrong debits, these are some of the things that we may have. Now, wrong debits is when the bank debits your account in error. In other words, the money was not supposed to be debited to your account. When the bank debits your account, it means they have charged your account when they were not supposed to charge it. Because debiting your account is like we are reducing your account. So your account may be charged wrongly. That's what we are meaning. For example, maybe they were supposed to charge a customer, but someone bears a similar name, and instead of charging the other person, they charge you. And for you can only realize that by getting the bank statement. By the time you get the bank statement, you realize that you've been charged for the things that you don't know. Because remember, the people who are actually working in those banks, they are also human beings. They make errors, though errors are assumed to be minimal, but they may happen. So what is going to happen is that your account may be charged wrongly, and when they charge it, or when it's debited, it's going to be reducing your balance as per the bank statement. So when you pick the bank statement, you can only find out that they had charged you the amount that you are not supposed to be deducted. So that amount will make the bank statement balance to be different from the cash book balance. So that's what we call a wrong charge on your account. Then the opposite is the wrong credit. The wrong credit is the opposite of a wrong debit. The wrong credit is when your account is credited in errors. The money was not supposed to be yours, but it has been credited on your account in error. Because what you have to understand is that this wrong debit, it reduces your bank balance, but a wrong credit increases your bank balance. As long as you know what is the impact of that factor to either the account of the bank or the cash book of the business. So your account can also be credited in errors. So when that happens, you'll find that your bank statement balance will be overstated because you'll have a higher value as compared to your cash book balances. And those are the things that we need to correct. The other that I want us to look at, the other factor maybe we can talk about are errors. Because errors can be committed anywhere. An error can be committed by the accountant in the cash book. Errors can also be committed by the bank in the banking details. So errors, they are just errors. Because it could be an error of commission, omission, commission, depending on anything. Someone can just skip the transaction. You didn't see and you didn't put it there. It will cause a mismatch. It could be a wrong entry. You could even overstate. Instead of writing 12 million, you write 1.2. You could even understate. And these can actually happen either in the cash book or in the bank statement. That's why here I'm not going to over-explain it more. But you have to just know the impact. What is the impact of that error on whatever side that has been committed? Because it can be committed in the cash book or in the bank statement. And once the error, or once there is a mistake, then you have to know the balances that are going to be changing. Then you can adjust those documents accordingly. So once we are preparing the bank reconciliation statement, we do correct those errors because we will prepare what we call the adjusted cash book or a revised cash book to reflect the changes that are to be made in the cash book. And then we will also prepare the bank reconciliation statement to reflect the changes that is to be made in the bank statement. So the two balances will now agree. And that's basically what we are going to do. But one key thing I want you to note is that when the errors are committed by the accountant in the cash book, if these errors, they are in the cash book, they are committed by the accountant of the business, they are now in the cash book, then you have to take note that though, because error can happen on the debit side or on the credit side of the cash book. But what you have to know is that when an error has been committed in the cash book, it must always be collected in the cash book. In other words, when there is an error in the cash book, it is supposed to be collected in the adjusted cash book. But when an error has been committed by the bank, then that error is supposed to be collected from the bank statement. That is very important. An error that has been made in the cash book should always be collected in the adjusted cash book. In other words, errors of the cash book are collected in the cash book. Errors of the bank statement are collected in the bank statement. And the way we collect in the bank statement is by using the bank reconciliation statement. The way we collect errors of the cash book is by using the adjusted cash book. And I hope we are getting those two things because they are very critical. I told you these theories They are the ones that are going to build on, we are going to use to build on in our computations. So when you are solving a question, you can see that we may find a lot of errors running through. So don't be confused as to where they should be corrected from, because the kind of guidance I'm giving you right now is that you look at the error to see whether the error has been committed in the bank or it has been committed by the accountant of the business in the cash book. And once it is committed by the accountant in the business, then it should be corrected in the adjusted cash book. And if it's committed, if the error is committed in the bank, then it should be corrected in the bank reconciliation statement. But we shall look at how it's going to be collected in the next video, of course, where we are going to try to understand and we'll get these formats and we take also a practical question as well, so that we can be able to improve our understandings. But for now, you can take those as our factors, but as I said, there are many. But for now, those are the main ones that you can take as the causes for the imbalances in both the cash book balances and then the bank statement balances. And as I said, there are other factors. We've not talked about things to do with the dishonored checks, but we shall understand them. We haven't talked about those dishonored checks and other things that may come up as we look at the numbers. So what I want to do now, I want to stop the video right here so that in the next video we can look at our bank reconciliation part 2, where we are going to look at the format of the adjusted cash book, the format of the bank reconciliation statement, and also decide on which approach that we are going to use to be able to do our reconciliation very well. So thank you for watching. Let's meet in the next video as we are talking about the same bank reconciliation part 2.